Shri Sahil Narula, Managing Partner, RNC Valuecon LLP. Shri Manish Mathur, Chief Internal Audit, M Junction Services Limited. Shri Chandan Shuriwal, Chief Operating Officer, Asserts Care and Reconstruction Enterprise Limited. Can we have a huge round of applause for them, please? Thank you so much for joining us today. To moderate this session, I would like to call up on stage Shri Rajiv Chandal. So much. I would request, ladies and gentlemen, all of you to please make sure that your phones are on silence. Thank you.
Thank you so much. Good morning and welcome to all the panelists. I would like to introduce Chandan Shuriwal, CEO Agar ARC, Jyoti Singh, AJ Legal, Sahil Narula, RNC Valuecon, Nikhil Shah, Alvarez and Marshall, Manish Mathur from M Junction. I'm Rajiv Chandak from Deloitte. We would like to have a great session. I have our August panels with me who will be speaking on various issues and challenges faced by resolution applicants. So just to start the flow, I think one of the key challenges that we see in many of the situations is the availability of data and information. Maybe I would like to understand from Chandan what has been his experience as resolution applicant and as a ARC while he is evaluating various situations.
Inferior data while doing diligence because our job is to buy secondary goods. So somehow I find IBC data is substantially better quality than what we are usually used to. And our experience, we have participated in, actually I personally participated in two resolution cases because subsequently ARCs are not allowed to participate because of the ambiguity or clarity which came from our end. But in the initial period when we participated, I did not find data quality to be so good. But yes, there is an issue. The issue which we saw even in non-IBC processes is around the team. Because the data is held by the team actually. Because the corporate data is available to provide data, unlike in secondary loan situations where corporate data is not available to provide data. And the incentive mechanism of that team to share the data is most important. Now, the thing which is required is probably for the RP and the process advisor to kind of work around with the team and incentivize the team. So in situations we have seen where, let's say, if some non-IBC situations, we have incentivized the team. If the team is retained, let's say if we give an assurance to them that, okay, you'll be retained for 12 months, then the motivation of the team to share and provide data is much higher. So some kind of a reward mechanism for the employees of the corporate data, if it can be built in, it can really help them provide, because data is available, corporate data is there, everything is there, and especially the professional setup, companies which are larger, data is not such a big issue. So that's our experience.
Nikhil, you have advised multiple resolution applicants while they have put in a bid. What kind of challenges in terms of information you have faced while evaluating those situations?
Firstly, let me just thank ASSOCHAM and Rajiv and my co-panelists here for the opportunity to speak. Yes, I mean, we have been involved in many of the insolvency cases. What we generally deal with the larger companies, as Chandan mentioned, and what we find generally with the larger companies is that information and data are available. I think that it is the responsibility of the resolution professional and the advisory team working with him or her to build credibility with the management team at the corporate debtor in order to make them understand that it's in their best interest to actually to share as much information as feasible, so that we can reduce the information asymmetry with resolution applicants in order for them to form a view on the corporate debtor and its value and potentially what they can do with it, so that they can put in a resolution plan that is fully priced from a value standpoint.
Jyoti, any thoughts from your side?
I think, again, I tend to agree with Nikhil and Chandan. The point is there will be some matters where there would be an issue with the data. But I think after the entire diligence, the resolution applicant puts bid, taking all these into consideration, right? Because it is on as is, where is basis. So when a resolution applicant is coming in the picture itself, they are aware that there may be lack of data, there may be some, there may not be symmetry of the data, and hence they do their diligence and place their bid. So I don't see challenge, lack of data is not a challenge for having less attraction of resolution applicants. We'll progress further to understand why there is not much of attraction.
Good to know, good to know. So Manish, I think another thing is that just to reach out to how can lenders broaden their search of bidders, and vice versa, how can bidders also can trace opportunities regularly? Is there a central thing that something can be done? What has been your experience as a information provider to various processes?
Thanks for having me. Firstly, regarding the previous point, I would have a small addition, and this was a point I heard in a previous meeting where the point being made is that even bankers, especially in small companies where the promoters are hostile and there's no data available, at least as far as the project appraisal and all that is concerned, at that time the banks were involved, and somewhere in the bank there is that information about the project report, the project appraisal. There is some information which banks have, and once again, of course, it's a tough call because who was there at that time, who kahan pe hai, file kahan pe hai, but you know, that it can be brought in and maybe it can be given to the applicant. That will make his life easier. So now coming to the present question, yes, see, as far as IBBA is concerned, they have made a commendable effort that the listings are available on the IBBA website at 3 phases at the time of entry into the insolvency process. Also, every call for the resolution plan is also listed on the IBBA website, and when the company enters into liquidation and the liquidation options are announced, so even those are listed on the IBBA website. So that is a given. But see, that is to some extent a kind of checklist or a compliance-based, by website they are देख लो. So that in our experience that does not work. Of course, we have been involved in selling assets. So you could say that parallels the liquidation asset kind of materials. That is about what we have been selling. But even there is a need for market making. There is a need for outreach. So definitely both in the liquidation and also at the insolvency stage, there is a huge need for market making. At the insolvency level, this is a M&A. It's an M&A opportunity. It has to be treated as such. So while the very big firms, the big 12, there, yes, it was treated as an M&A opportunity, and to that extent, so yes, you need to have provision for professionals to get into it.
Nikhil, any thoughts from your side how lenders can do the justice in, or rather a resolution professional, because resolution professional needs to market the asset well. What kind of things he should be looking at while reaching out so that he can reach out to the best of the participants, and vice versa? What will be your thoughts? How bidders can look at these opportunities?
I agree with Manish's point actually that in order to what actually is happening through the insolvency process is a sell-side M&A exercise, and for that you want to get a target a universe of potential investors or resolution plan applicants that are from that industry or are capital providers or investors that actually are attuned to acquiring a business in that sector, and also businesses that are going through an insolvency process, distressed assets. In order to succeed, because there's a short amount of time to elicit interest from that universe, you have to have an agency that actually has relationships in that sector with those types of resolution plan applicants in order to get them to be to get interested in the asset, from first taking a look at it to then actually going through the entire diligence and insolvency resolution process, which can stretch for a very long period of time, and to keep them interested through the process. That requires actually a specialized agency, an investment bank, a corporate finance practice that actually does that on a regular basis. It's impossible for just a resolution professional to carry out that function if you want to try and optimize what the value that is received through the process. So I would highly recommend, and it's not just me that is saying this, it's now demonstrated over the last 550 cases that have actually been resolved. The ones where the people have done a better job in terms of the sales process and trying to get the right parties, resolution plan applicants to the process, have yielded better outcomes.
Chandan, any thoughts from your side?
Actually, agree with Nikhil, but there are 2-3 things which I feel which we can do further to expand the universe of bidders, potential bidders. One is reaching out to the bidders, and second is motivating the people who are potential buyers to really come and participate in the messy process. Because ultimately, from a friendly guy, they would be more comfortable doing a friendly M&A rather than coming through this process, which is kind of more complex. So, 2 suggestions. One suggestion is basically, see, in COC there are typically lenders, and it is the stress asset department of various banks which is sitting there. Now, they have a corporate banking team which has excellent relationship with potential bidders. Now, if the information can be passed on, and this can be actually treated as a service, because for the corporate banking RM, it would be kind of, if he's highlighting these opportunities which are probably lucrative. So they can, within the bank's 2 departments can talk to each other, and these opportunities can be passed, just to increase the reach of the COC to the potential bidders. Second is a situation where we, in order to increase competition, and this is more long-term at least, and maybe I'm slightly biased because I'm representing an ARC. See, we probably need market makers in this kind of activity. I'll give an example. In 90s, when there used to be physical shares traded, there used to be these odd lot shares. Let's say 5 shares instead of 100 shares, because market traded at 100 shares. So in each of these regional exchanges at that point of time, there used to be a market maker. He used to say, okay, this particular stock, whatever is the lot, I will buy, I will consolidate, I will do everything, and then I will kind of sell in the regular market. He used to give a discount. There was a discount to the price. Similarly, we potentially possibly need market makers here, and I believe ARCs are the best suited to be the market makers. I know there is kind of restriction. An individual can participate, and ARC requires a lot of criteria to participate. I'm sure ARCs will make money in this process, but once this process evolves in the longer term, when people can see ARCs are participating, it's ultimately coming up, buying it, cleaning it up, and selling it back. So, potentially as a wide idea, I believe this could be an opportunity.
Excellent thought. Yeah, Jyoti.
So I think, see, until now, what was happening before 2022 is that it depended on the RP and the relationship of the RP, and which RP or is basically getting engaged. But now with this regulation that is coming, the amendment in 2022 that is coming, now it is the role of RP and the COC in a way to really draw a strategy to market the asset. So I think, as everyone is saying, that now there has to be a market making. It is a new avenue for new professionals to step in, and it will become more crystallized process to really, in that sense, market the assets. So that will also help in investments further in IBC.
So one more question for you, Jyoti. So I think one of the most controversial topic is how can we curtail delay in the entire process. I think once the resolution applicant puts a plan, there is a lot of delay in approval of the resolution plan, and there are various reasons. So any specific thoughts, any specific things you can guide resolution applicants that they should take care so that their plan can get approved faster or something like that?
So I think here, unfortunately, instead of having any advice for the resolution applicants, I think I have advice for others. Because see, I think regulator is doing its job, right? There has been 84 amendments in the in the regulations from the time the entire law has come in. 22 regulations have come in. The legislation is doing its job where there are 6 amendments that happens, right? So has happened till now. So I think the regulator and the legislature is doing their job very well. They are listening to the market and they are really, in that sense, incorporating all the suggestions. The delays are happening at 2-3 levels. One, of course, when I sit as a RP council or a COC council, I very consciously tell my client that we need to really be sure what applications are we putting in before NCLT. We are putting in before NCLT because we need to be very conscious that when any resolution approval application comes up for hearing, it is bundled with 20-30 other applications. Now, if you carefully look at those applications, majority of those were not even required to be filed. Because RPs are filing non-cooperation applications at the fag end also. Because each application that is filed is gonna be leading to delay in approval of resolution plan some or the other way. Of course, now NCLTs have started categorizing it in A, B, C, D, which application should be taken with the resolution plan, which should be taken subsequently. So one is we need to be very conscious as to how and when we are really proposing to file application, and COC can also in that sense be an active participant with the RP, whether those applications should be filed or not filed. That is the first thing. Second, of course, I think the NCLTs, of course, are overburdened. Members are getting appointed. We are getting new members in each NCLT. That all is fine. But I think hybrid model needs to restart once again, though the physical has started. But I think at the NCLT level, I feel that the NCLT should not look at the year when the resolution plan came for approval, because it has recently happened that there are resolution plans worth 1,000 crore, 2,000 crore pending for approval of NCLT, which were filed in 2022. So what we hear from members is, hang on, it's not urgent, you have just come in, there are 2019 waiting. But I think that approach needs to slightly change. We know that they are really overburdened, they don't have support. So I think one, from infrastructure point of view, there can be some process where they can get interns, because we as lawyers have our juniors, we have interns, senior counsels have briefing counsels, RP has their support team. But NCLT unfortunately doesn't have any support to really, in that sense, prepare list of matters for them and what are the issues that they need to look at. And I feel if amongst the 5 days working of NCLT, if a day dedicated can be given for resolution plan approval applications, then I think there can be, there can be some progress that can be made in delays. Because what happens typically for the RA is that when they file a resolution plan, they need to have, they need to show their financial viability. Either they need to have binding offers from the banks or financial institutions, or their balance sheet need to have that strength. But if the delay itself in approval from NCLT will take about 2 years, 1.5 years, then of course all that will go away. So I think we need to really look at, again, not criticizing the judiciary, but I think if we can all enable it, somewhere I think the delays happens, and I think the investment will increase, as I said earlier, not because of the lack of data, but I think it's the delay that happens post approval or post submission of the bids. So yeah, that's the few suggestions.
Nikhil, any thoughts from the global parlance if there are some best practices that we can adopt which can help expedite some of these NCLT processes, be it admission, be it resolution? There is a lot written in the code and I think preamble of ILC that COC is supreme. So any thoughts on those aspects?
I think that there are actually many suggestions that have been made today in terms of what's impacting the insolvency resolution process, a process that was initially supposed to take 270 or less days, and now is taking over 500 days on average to resolve. That is way too long for If it's a very large case, I can understand that there would be delays and complexities to deal with. But most of the cases are not in that category and should ideally be resolved in a much shorter time frame in order to keep both creditors that are waiting for that resolution to take place to be engaged to use it as a mechanism for resolution, and for potential resolution plan applicants, investors who are looking to try and acquire these assets. If it's taking 2 years or more to actually acquire an asset, that's far too long, because they have other options in which they can deploy their capital and actually make better returns. And so, to me, if I were to distill this to one issue of what is impacting the delay, in my view, it is the number of judges that are available. At the start of the IBC, it was budgeted that there were supposed to be 63 judges in the NCLT that were to be managing both company law as well as IBC matters. Currently, now 6 years later, we are at somewhere in the mid-40s in terms of judges, whereas the caseload has gone up by 10x, actually. And so it is impractical to imagine that a lower amount of judges, volume of judges, are able to manage the number of cases and apply themselves in a qualitative manner to these cases to get them resolved as quickly as possible in the highest quality manner. I think that if I were to just leave the MCA and the IBBI with one thought today, it would be that we need to desperately increase the number of judges to at least more than 100, so that we can address the backlog of cases and the oncoming volume of cases that are expected as well.
Excellent. So Sahil, I think one of the very critical challenge that in many of the processes COC and the bidders faces, there is huge gap in terms of bid and ask. So you have done most of the complex valuations. Any thoughts from your side on what are the challenges and how that can be bridged?
Thank you so much for having me on this panel, and thank you ASSOCHAM for the same. So today, my role here is to give the perspective of a valuer. And Rajiv, let's just recap what we spoke on. A, we spoke about the challenges faced in the process. B, we spoke about the unavailability of data. C, we spoke about the lack of the infrastructure. All of these have somewhere added up to there being a wide gap between the bid price and the valuation, right? And somewhere maybe the lack of information memorandum, lack of transparency. The more the opaque the system, the more the opaque the data, the more are the unforeseen circumstances and events, the more will be the gap between the bid price and the value. Now again, I would like to show both sides of the coin. A, where we have seen that there have been 550 cases odd which have seen the light of the resolution. The liquidation value, the ratio of the liquidation value to the resolution plan realization is about 1.7x. So what that shows us, and what it clearly shows, is that we have seen the Bhushan, we have seen the other steel companies, maybe SR, we've seen the power sector companies, is that they have a substantial value which has been unlocked in the process, and hence there is a large delta as opposed to what the bid price was as against the liquidation value ascertained by the valuer. Now talking about the other side of the coin, and which are more in numbers, are about the 1800 cases which have gone into liquidations. That essentially means that there have been bid prices, there have either been no bid prices, or the bid price has been lower than what a valuer has ascribed against those assets. So again, the reasons for the same have already been discussed and deliberated at length, but I think this is part of the ecosystem. We'll have to live with it. In a perfect market scenario where there is a perfect competition, there is appropriate marketing of the underlying assets, and a demand and need is created for the underlying assets, that will be the time and situation and scenario, ideally, when the bid price and the value will converge. And I think as we progress ahead, we will move more and more towards that path of convergence between the bid price and the value.
Excellent. Chandan, you have been on the both sides. You have been acquiring loans and you have resolving loans. So, any perspective from your side? What kind of bid-ask gap is there in terms of resolution process, and how can lenders look at it differently? I think people are thinking of different ways to bridge this gap, sometimes by maybe looking at asset by asset kind of approach and trying to see how they can structure a resolution plan. Any thoughts on that?
So see, bid-ask gap is very natural. It is there in every market. Every purchase sale transaction there is always a bid-ask gap. Even in secondary loan there is a significant bid-ask gap always. So it is natural. But here there are two issues. One is actual gap and one is the perceived gap. So earlier in the panel discussion also, when Mr. Sharma was there, and see what happens is a lot of times COC members are themselves, and I'm saying this with full responsibility because we ourselves as COC members in many situations are not fully aware of the account. See, there is a value of an asset, but what we are selling is asset with various caveats. It is not just selling a clean asset or with full indemnity and things like that. So the issues around those assets, the COC members, everybody has to be aware, and even the valuation has to factor those issues. So, and some of these situations I can tell you can be binary. In many of these situations we have also participated in. At least the two situations which I spoke about where we participated in as a bidder. The outcomes were binary. Let's say there is an asset which is on a land where the land title is disputed or land title is subject to somebody's approval, and if you don't get that approval, then the value of the asset is zero. Now you can put whatever liquidation value you want. So in those situations, if there's a bid-ask gap, I would say it is a perceived bid-ask gap, because unless until you are solving the key issue, the value is zero. Perceived bid-ask gap can only be solved through effort, both of RP, process advisor, as well as COC. Where COC members put in time and effort to understand the issues involved, and therefore that is factored in the valuation which is done for. Second is actual bid-ask gap. Now, actual bid-ask gap, there is only one way which I understand, which is competition. As long as you create competition for bidders to come in, and for that, not only the Indian corporates, maybe the global guys also want to enter India for that asset. We have to target all of them, and it has to be. And sometimes competition may not really be there, but it can be created by just making the process more easier so that more people participate. And so once we create competition, that bid-ask gap can be created. And the third and the most prominent thing would be you have to sell the asset in a more value-added form. If you are asking the buyer to resolve all the pending issues, then buyer is going to discomfort. So now the effort has to be made, and I believe this whatever is happening with debt aggregation by NARCL and things like that. So the responsibility, because COC then gets aggregated at one place, this would possibly help in resolving those issues. We ourselves, when we kind of aggregate entire debt, we work on each of these issues and kind of selling that asset. And we try to work with even government authorities, with whatever various participants to address those issues. If you address those issues and you sell the asset, then obviously it will price higher and then the bid-ask gap will be low.
Manish, any thoughts from your side? Anything can be done from platform perspective to address this issue?
Of course, Sahil has already covered that. And so actually, from the auction story angle, we learned that around 6 bidders is that level where you can get the best price. So this is what auction theory experts tell us. So of course, we have not been anywhere close to 6 bidders in any of the cases, I would say. But you would recall that you had 2 or 3 eager bidders as far as the initial Bhushan companies and the SR companies were concerned, and at that time they were so eager that they were each outbidding each other in the Supreme Court in the Main aur Dunga types. So that is what is required. So can you reach out to 6 possible bidders who are likely to be interested bidders? So it's again back to market making. That is my take on this. I think I missed part of the question.
Question was more on bid-ask gap. So there is a bid-ask gap.
So I mean, if I am a bidder, what is my dharma? I mean, my dharma is to drive low. I mean, it is my duty, it's my care. So it's up to you as a seller to bring in 5-6 people who are equally interested and really are willing to fight together. I think it sounds crazy, but
smaller assets is somewhere where I think there's a lot of marketing that needs to be done, and I think twisting.
I think
some of the platforms can definitely help.
Yeah. So, see, we have been working as far as smaller assets are concerned for more than 20 years now. So, yes, smaller assets require a different kind of market making because we have specific industries with clusters. And as far as smaller assets are concerned, as Nikhil said, you have to look at the industry, the direct competitors, then companies in the up and the downstream, they might be interested in integration, and also the asset reconstruction guys. So this is the target, you could say, segment for the applicants.
Thanks, Manish. Sahil, there is another thing which affects the overall resolution process is liquidation value. A lot of time liquidation value is so high that resolution plan amounts are lower than that. Sometimes liquidation value is so low and resolution plan amount can be much higher. In one or two situations, NCLT has questioned why is plan values exactly close to the liquidation value. So what do you think about liquidation value? Should it be considered closer to ICD? Should it be closer to the process ending? What is your thought process on this?
Sure. So thanks. I think this is the most this is the most debated question as regards the difference, as you mentioned rightly, between the bid ask, and the ask here is nothing but the valuation given by the valuer. And at times we heard that at the time of sanctioning of the loan the value is 100, at the time of CIRP the value is maybe 10, 15, 20, and you also mentioned that there may be a wide divergence or there have been instances of coincidence or otherwise convergence as well to the price. So, and coming to your question of when should the valuation, the valuation should be dated as per what date. So again, thanks to COVID, this question has arisen because prior to COVID, there was no opportunity to ask this question that can we actually evaluate closer to the date of resolution or not. But the code mandates us to value as on the ICD, which is nothing but the insolvency commencement date. And we have seen, as per the IBBI newsletter, the average time to resolve a company is 560 days, nothing but about almost 2 years, right? So what has happened is that thanks to COVID, this question has come into the picture that there will be a lot of cases which were admitted pre-COVID, and then the resolution obviously happened later, and then there was a large difference in the circumstances on ground, and hence there was an opportunity to revisit those valuations and market to market and bring them close to reality. So this is a big positive that COVID brought into place. What it also did is that there were a lot of other cases where there were so many things which actually transpired. I mean, I have seen in fact 2 cases in which there was one had a major fire incident, and the entire the corporate debtor property had entirely collapsed. So it turned down to ashes. Now, how can you actually not consider such a large event and look at something which is dated only because the code mandates you to look at something which is dated? But again, ultimately it depends upon the commercial wisdom of the COCs, and now COCs have been empowered and they have been very proactive in taking decisions which have been close to reality, and hence they have been asking valuers to give a valuation report as close to the date of resolution as possible, so that they are able to categorically capture, because again the bidder is going to bid as on today, wherein today he doesn't see any assets because he already turned down the rumbles, and what he is only probably going to get is a claim against which he will have to pay money and get it again from the insurance company. This is an example, and there are so many examples which we can cite. So my summation here is as close as possible to the resolution date. As far as there has been substantial difference, if we are able to maintain the timeline of 270 days and there is no significant difference, then we can obviously look at the ICD date, and that discretion can be taken by the COC and the resolution commission.
So in fact, I have a live case, on the similar issue. MSME sector got admitted prior to COVID. Nothing happened in COVID. Valuation was carried out. The company was running until 2 months prior to the ICD. In COVID, theft happened. All the valuables of the factory taken away. RP filed FIR. Employees left. 3 bidders were there who submitted their bid during COVID. The RP changed at the fag end. RP comes in, decides to just, along with the COC, decides to call for a meeting put these resolution plans on, on voting without even considering the request of the promoter, because the promoters are not always hostile. Ultimately, the promoter's ask was that carry out another valuation, because the valuation that you are today putting in is not the liquidation value at all. And there is already a discussion paper by IBBI on this, and I think it's high time that a regulation needs to come around this, that the valuation needs to really happen some days or closer to the voting period or the submission of resolution plans. And today, the COC rejected unanimously all the 3 resolution plans because it is lower than the liquidation value. We fought before the NCLT, but of course, after a point of time, the promoter runs out of money. And hence we gave up that defense, and ultimately now, it's reserved for orders. But this valuation which was done 2 years back is not good enough to really, have the real rejection of the resolution plans merely because it's below the liquidation value.
Thanks,
Yeah, I think that one point that I'd also ask Sahil, actually, from a valuer standpoint, is that the methodology that's used in the liquidation valuation that I've seen often is not a market-based technique. It's often a replacement value in terms of what fixed asset investments has happened and depreciation, etc., to come to some value. And that is quite different than how a resolution plan applicant thinks about the value. They typically are looking at the trailing 12-month cash flow that the asset generates and looking at the sector and the distress that may be there, applying a multiple on that cash flow. That is what we have seen from most resolution plan applicants in terms of how they think about what they want to bid for the asset. Along with that, they look at what the competition is, if there are other people, and how badly do they want that asset, and what can they do with that asset in terms of value creation as well. These are the main factors. And so there's often a divergent view that comes about as a result. The second thing I want to point out is that liquidation value that is taken as the ask, actually, oftentimes is not real, because after, let's say that there's no resolution plan that's submitted and the company goes into liquidation, do you know what the recovery rate in liquidation is? It's like 1 cent or 2 cents. It's nothing. So even where the valuation report is indicating a liquidation value with a 10, 15, 20% type of recovery, these are not being achieved. So the ask, to Chandan's point, is more about perception than actual facts.
Thanks, Nikhil. So I would like to address both your points that you made. I agree with you completely that the way a bidder looks at a asset is very different. What he looks at is not just the asset, but he looks at the enterprise per se. Now, the way banks have evolved with the process is that what banks do before the admission is, they would carry out an enterprise valuation of the company, not just the underlying asset, and they would test that against the fixed assets or the assets of the balance sheet. If the enterprise value per se is lower, what that essentially means is that what you will realize is nothing but the assets of the company. And hence, only in those circumstances, it makes sense to admit that company into insolvency bankruptcy and liquidate, resolve the assets of the company, because the valuer under the code is going to value only the assets of the company per se. And hence, but I completely agree with you. In the earlier part of the code, what we had seen was that earlier part of the IBC journey, what we had seen is that even companies which had a good enterprise value, that is clearly seen that the valuation there was X, while the bid there was maybe 2.5X, 3X, and these are large assets. That is primarily because the enterprise value was not tested prior to its admission, which is now clearly seen the case. The number of admissions have declined substantially, primarily because those enterprise values have been tested, and only where the scenario is that the asset value is higher is only the case that the admissions happen. Second, I completely agree with your point regarding the recovery being lower in the liquidation scenarios. Again, the difference is that as Mr. Manish also mentioned, that it is a dharma of the bidder to bid low, right? While it is the dharma of the valuer to be neutral neither to the buyer nor to the seller. Valuation is nothing but a willing buyer, willing seller concept, and not just a willing buyer concept. If I want to buy, I would buy it low. If I would want to sell, I would sell it low. So that onus of striking the right balance. I mean, I understand, you need strong shoulders to, shoulder the responsibilities, because हमारे कंधे पे रख के काफी बंदूकें चलाई जाती हैं, and hence because we have to be neutral to both the parties, and hence I agree with your point that there have been recoveries and realizations, maybe 1 or 2 cents to the dollar, as opposed to maybe 10 to 20 cents to the dollar as per the valuation. But again, that is primarily because of the term of the bid ask between the valuer and the bidder.
Thank you so much. It was a very, very informative session, and all the panelists are available for any further questions. I think we are already running late. That's what I understand. One last one question. Yes, sir.
I'm IT and I have a very simple suggestion for these valuation implications. That there is a IT valuation under IBC requirements. There is a valuation independently may be carried out by the prospective bidder. There can be also a third valuation from the promoter, because it is his assets which are under the sale. And if all the three combinations are there, and in entire COC meets with the total wisdom, then lot of solutions will emerge out. That is my simple suggestion out of all this discussion. Thank you. And the last but not the least, in our India, we know each and every implications that land, particularly for industrial enterprise or in a commercial wisdom, there is a declared versus undeclared component of the value. We are here talking about the declared component implications and other related issues. Whereas it is a seldom open discussion among the various stakeholders, what can be the declared versus undeclared component of the values and its implication. Thank you.
Thank you, sir. Thank you so much.
Thank you. Can we have a huge round of applause for them, ladies and gentlemen? That was a great thought-provoking discussion. Thank you so much for joining us today.